let's just discuss that real quick. What's the difference between a pre-qualification and a pre-approval, for example?
Sure. So a pre-qualification is going to be where the loan officer will pull the credit. Okay, a true pre-qualification, they should pull the credit, analyze the liabilities, take a look at the income, really, understand what that income looks like, and take a look at the assets, make sure that they have sufficient funds to close and to get to the closing table, and based on that information, run it through AUS, which is automated underwriting system, which most lenders should run their files through, and as long as that all checks out, then you can issue a pre-qualification letter.
Okay, got it.
Versus a pre-approval where it takes it a step further. Where it takes all that information, actually submits it to an underwriter who then reviews the file and issues a conditional approval.
Right.
Right. And condition based on, okay, everything looks good here. We're just waiting on an appraisal at that point.
Got it.
Right.
Got it. You said credit, and it just made me think about it. And I'm sorry, I pulled this up here because, following our show is Michael Ramos with Credit Rescue New Mexico. Yeah. So Michael does his show and helps people clean up their credit. When you guys price, or not you guys, it's not really you that price it, but your credit score will affect how much your mortgage rate is going to be. We're going to circle this all the way back to mortgage rates, right?
Yes,
so when you see mortgage rates being quoted out there, and let's say they're quoting them at let's say 3.75 or something, right? For people to get the very best mortgage rate, what kind of credit score do they need to have?
740 is 740 plus is where you want the credit score to get
That's the magic
rate.
number.
Yeah, that's the magic number. Yeah.
Okay.
And so rates, and I'm glad you brought that up because you're right. When there's a lot of competitors out there that are throwing rates out there that are saying, oh, that we have these super low rates, but there's a lot more to it. One, are there any points associated with that, right? We can talk about that too, right?
Yeah.
But there's also what's called loan level pricing adjustments, where credit makes a difference, how much you're putting down, whether it's a purchase or a refinance, the type of home, single family versus multi-unit, versus condo versus
second home versus an investment.
Right? So all those factors come into play on how they're going to price your rate out. But credit is a big factor in that. More so on conventional loans. Conventional loans are very credit sensitive. Okay.
Just real quick, in the couple minutes we have left, conventional versus like FHA, what's the difference?
Conventional would be Fannie Mae, Freddie Mac. Okay, they're government backed.
Yep.
Okay, so they're private entities, right?
Okay.
They're the biggest. 65% of mortgages in the United States are backed by Fannie or Freddie.
Okay.
Then you have FHA, which makes up about 20%.
Okay.
And those are government mortgages, HUD, right?
Okay.
And then you have VA, which is about 10%.
Okay.
And those are for exclusive for veterans, probably one of the best loan programs out there.
They are.
Loan program,
Yeah, they
100% financing.
Yep.
And then you have USDA, which is a small percentage. And then after that, you have maybe portfolio and non-traditional types of mortgages.
So, and I know there's like hard money and portfolio. Do you lump hard money and portfolio kind of together?
I do. Yeah, just kind of like the non-traditional hard money portfolio, that kind of thing. Yeah.
So to a certain extent, those type of loans are your traditional bank loans, right? They actually hold those loans on the balance sheet of the bank or whoever.
They insure those ones,
themselves.
Instead of Fannie Mae, Freddie Mac, FHA insuring those, the government insurance.